Good morning and welcome everyone. One moment while I get my guests up on the stage. Feel free to let us know who you are and where you're from in the chat. It's nice to know who we're talking to today. Cool, so my guests should be popping up now. Cool. Hi Ashley, how are you?
Oh, I'm very good, Stacey.
It's good. And Lou's popping up there. Cool.
Great.
Awesome. Hi Lou.
Hey, how you doing? Hi, Ashley.
Hiya.
Cool, so welcome everyone to today's session. If you're new to Relab's webinars, my name's Stacey and I'm the Content and Social Media Manager here at Relab. And joining me today is Lou Donnelly-Davey, our CMO at Relab, and our guest today is Ashley Church. Today's session is all about what's happening in the property market at the moment and getting Ashley's view on how interest rates and inflation are impacting the market. We thought this was quite fitting to do this topic now, as there are a lot of opinions going around, especially since we've seen quite a few changes happening in the market. Being in a few property Facebook groups myself, there's quite a lot of fear of what to expect at the moment. So I think this one will be a great one to maybe clear some minds. And if you aren't familiar with Ashley, he's a very well versed commentator on property, economics and politics, just to name a few. There's quite a few more. And just quickly, before we get into the chat, I just have a few admin things to cover. You will receive a recording of the webinar later on today if you can't make for the whole thing, or if you've got any tech issues or anything like that. And if you've got any questions throughout the webinar, just pop them in the chat and we'll get to them at the end. Cool, so we'll get into it. Ashley, do you mind letting us know a bit about your property background?
Oh, gosh. Goes back about 35 to 40 years. I started investing when I was very young. I think I was in my late teens or early 20s after reading Bob Jones's book, Jones on Property, in Hawke's Bay. And had, by the time I was 22 or 23, I had 7 rental properties, which I subsequently sold within about a year of buying them, which was an extraordinarily stupid thing to do. It was a reflection of my youth and naivety, and didn't get back into property again until the early 2000s. But learnt my lesson from that first foray into it, and have done reasonably well on a number of measures over the last 20 odd years. And over that period of time, probably due to the fact that in the early 2000s, I was also the CEO of the Auckland Property Investors Association, developed a little bit of a media profile to go with it. So over most of that 20-year period, I've also been a commentator on the property market, more recently, as people will probably know, writing for a number of publications and speaking on TV and a few other forums. So it's probably just worth making the point at that stage, Stacey, that anything that I say is always just opinion. It's not always right, but it comes with that sort of 35, 40 years of experience of what I've seen over that period of time.
Perfect. And can you give us a brief outlook on what you see happening in the property market and some of the reasons that you see behind that?
Sure. So there are really 2 schools of thought when it comes to the property market. There's a school of thought that says that the property market's like a big ocean that we're all sailing on, over which we don't really have a lot of control, and that what happens to it at any given point in time is of the result of things that are happening at that moment in time, and which in most cases can't be anticipated or predicted, and therefore we basically just have to go with those things and roll with the punches. There's another school of thought, the one that I ascribe to, that says that if you look at the market and you actually take account of the very large amounts of data that we have of what's happened to that market over the last 50 years, that there are certain things that happen on a relatively regular basis that are predictable. And that doesn't mean that every single aspect of the market can be predicted, but it does mean that we can have some idea of what the general trends are likely to be if the market is to continue doing what it's done over that last 50-year period. And if you buy into that second camp, and as I say, it's one view, the other one is equally valid, then you would have an idea of what's likely to happen both in the next 12 to 18 months and also over the next 5, 10 and even 15 years. So if you're in that camp, which I am, and you're looking at where the market's at the moment, then you would say that there are some features of what's currently happening which are relatively predictable, and that if they continue to follow the trajectory of the last 40 years, we'll do certain things within the next 2 or 3 years that we can kind of guess and know where we'll end up. And so for that reason, I'm not particularly worried about what's happening in the market at the moment. There are some unique features of what's causing what's happening right now, and I'm happy to talk about those during the session. But there are some bigger trends, some mega trends, if you like, which are entirely predictable, and which we would be expecting to happen right now, which are taking place pretty much exactly as you would expect them to.
Yeah, just on that note, Ashley, I'm down here in Dunedin. It's a little bit cold and drizzly down here today. And we're property investors alongside some other things that we do down here. There's a little bit of rhetoric at the moment that, every market's crashing. We're not seeing that here in Dunedin. We're certainly seeing a correction in some suburbs, which perhaps have run away, due to supply and demand issues. But certainly in the suburbs that are, potentially, doing well generally over the sort of the last 5 or 10 years, they're still keeping quite buoyant. In fact, still probably going up. What's your sense of, the rhetoric around market crash?
Yeah, so firstly, there isn't going to be a crash. So let's be really clear on that. Let me put a line in the sand. There is no crash. There's not going to be a crash. What's the Oscar Wilde who said that the predictions of my demise are greatly exaggerated, or something to that extent. So what we are seeing at the moment is a flattening of the market in some parts of the country, and I'll come back in a couple of moments to explain why that might be happening. But this idea that we're reading at the moment, this almost gleeful headline pursuing that we're seeing from various different commentators around the idea that there's an imminent crash and that it's coming as a result of a previous bubble is just nonsense. It's nonsense pretty much every time it comes up. That's not to say that there couldn't be a crash at some point, but the features of what's happening in the market at the moment are not the things that are likely to cause that. They would be things that would be international in nature, and they would take on a very different complexion. And indeed, the things that were happening in our market right now would be very different as well, and they're just not. Let me talk about why I'm confident that there's not going to be a crash and that the situation at the moment's different. I talked before about trends. I talked about the idea that the market goes through predictable trends. One of those trends is, and not everybody believes this, but it's something I'm very, very strongly attuned to. One of those trends is the idea of a 7 to 10 year trend in the market, which anticipates what will happen in the market at a given point in time. Now, I say that because when I go back over 40 years, you can see that 10-year trend repeating again and again over that 40-year period. So every 10 years, approximately, the median price of houses in New Zealand roughly doubles. Now, it's not exactly a doubling. In some places, it's much more than that. In some places, it's much less. But as a general trend around the country, you can expect that whatever a property is worth today in 10 years' time, it's going to be worth sort of somewhere around, in broad terms, twice that. Now, the other interesting thing about that trend is that there is 2 aspects to it. There's the Auckland trend, which in my view, by observing the market, it's always about 3 years ahead of the rest of the country. So what that means is that Auckland goes into that upward cycle about 3 years ahead of the rest of New Zealand. And again, that's an oversimplification because there's places like Queenstown and Tauranga which act a little bit differently as well. But in general terms, Auckland goes up a little bit sooner. The rest of the country, about 3 years later, comes out of a flat period and starts going into an up cycle as well. Now, why that's important is because in 2020, if you'd followed that trend and you looked at those numbers, 2020, 2021, the Auckland market should have started to go into an upswing because it had been 3 years flat. If you look at the figures, you can see that very clearly. The Auckland market between 2017 and 2020 was flat. The rest of the country was still doing reasonably well. And what should have happened is in 2020, the Auckland market should have started to go up again and the rest of the country should have flattened off. Now, that didn't happen. Auckland market definitely took off again, but the rest of the country carried on strongly as well. And if you look back on the reasons for that, those reasons are tied up around what the responses were to COVID. It was around what the Reserve Bank did with interest rates and some of the other measures that were taken to try and stabilise the market based on this fear that there was going to be a downturn caused by COVID. And so those regional markets carried on for another 12 or so months. In fact, not only did they carry on, but we saw the biggest 18-month period of capital growth in this country that we'd seen in our history. Now, if you read anything that I've written over the last 18 to 24 months, you'll see that what I was saying over that period of time was that continued strength in the regional markets couldn't continue. And that it had to flatten off because unless the rest of the last 40 years were completely wrong, that cycle was going to dictate that at some point those markets needed to flatten and stay flat for a 2 or 3 year period before they started taking off again. Conversely, the Auckland market should have continued to go up because it was in its upswing. And so what's happened in the last 3 to 4 months is we've seen the changes to the market is that the regional markets have flattened off. About a year later than you would have expected, but that's what we would have expected them to do at some point. So they've now done that, and we would expect them to stay there for 2 or 3 years period before they take off again as well. But the Auckland market is also flattened a little bit at the moment, and that's why if you read anything I'm saying at the moment, I'm talking about the Auckland market shaking off what's currently going on and picking up again. And a lot of people laugh at that and say, how can you say it? I can say it because I've got 40 years of data that suggests to me that that's what will happen. So that then comes down to why is that happening right now? Why is that different to what's happened to the market over the last 40 years? And there's two really simple answers to that. The first one is the Reserve Bank's response to that massive increase in capital growth that we saw over the last 18 months, which to be fair was not because of that capital growth. It was because of inflation. So what's happened is that we've had a big increase of inflation worldwide. Some of that's imported, some of it's as a result of what's going on within the local economy. The Reserve Bank has gone, oh my God, this isn't what was supposed to happen. And that big decrease that we've had in interest rates now needs to be reversed in order to squeeze inflation out of the market. And just to explain that very quickly, guys, the Reserve Bank uses interest rates in order to reduce liquidity in the market, and it does that so that as you reduce that, you reduce demand. If you reduce demand, inflation comes down and you get inflation back under control within that 1% to 3% band that the Reserve Bank focuses on trying to keep our inflation within. So that's what they're doing right now, and it will work. It will take probably a couple of years, but it will work. It will squeeze inflation out of the market. The impact of that however, on the housing market has been because interest rates have gone up. They've also gone up, obviously, within the housing market, and that's impacting on house prices. And it's impacting on house prices in two ways. One, in a real way, it's actually making it more expensive to afford to pay a mortgage. But the second way, which is impacting on it, is in confidence. People are looking at that. They're thinking there's going to be an increase in interest rates progressively over the next couple of years. My interest rates are going to go up. What's that going to mean to me and my ability to pay a mortgage or to buy another house? So that's the first change which has taken place. And I think that change, particularly in respect of Auckland, will be relatively momentary, by which I mean within 3 or 4 months, we will have adjusted to that. We will have normalised our behaviour in respect to those increases in interest rates, because we will have recognised that the sky hasn't fallen, that the earth is still spinning, and that yes, while it's more expensive to pay what we were paying on a mortgage relative to what we might have been paying a year ago, we can actually survive within that environment. And I say that because that's what tends to happen with any new government policy. We look at that policy initially, we think, oh my God, the world's going to end. It doesn't end, and then we tend to normalise our behaviour and carry on. The second thing which has impacted on the Auckland market, and indeed the rest of the country, were the changes that took place to the CCCFA last year, which every man and his dog recognised were going to impact on the market. We all knew when we looked at the implications of what were being proposed. Everybody knew, there were people talking about it, writing about it at the time, that it was going to impact the market. The government ignored that and went ahead and implemented the legislation anyway, and it did exactly what what the commentators predicted. It severely impacted the market. That's why over Christmas you saw those headlines about people going to Kmart and spending $187, and that being the cause of them being refused on a mortgage application. We saw examples of people being refused for mortgages because they were spending too much on coffee, or they were putting money into KiwiSaver. Bizarre reasons, things that would never have impacted on mortgage applications previously. And so as the result of those two things, that progressive increase in interest rates and the changes to the CCCFA, we've seen this sudden shock to the market, which, and I'm absolutely clear on this, which is what's caused the loss of confidence that we've had over the last 2 or 3 months. So as I say, the regional markets, I don't think will come out of this anytime soon, because you wouldn't expect them to. They're in their flat period. This is a traditional thing that's happened for at least 40 years. But the Auckland market, I think, will shake this off. The Auckland market will shake it off relatively quickly, and you'll see not huge capital growth, but you'll see more traditional capital growth within that market, I think, within 6 to 12 months, and carrying on for another 3 to 4 years after that.
Yes. Got a dog.
And the dog barked when I finished. So
a dog, and we get a lot of couriers. So for me and for a lot of people who invest in different things, like for instance crypto or share market or startups and things like that, for me it's all just about just hanging in there and knowing that everything's cyclical. You look at the share market, for instance, some people freak out, some people see a dip or going red as it's sale time. So I guess without giving advice, a lot of the time it's just worthwhile just to hang in there. And we're probably a similar age, and we have seen these cycles in our lifetimes, and it's no different in the share market or crypto or anything. Startups are slightly different in terms of an investment portfolio because they're higher risk, but everything is cyclical. That's pretty cool advice. Stacey, have you got some questions?
Yeah, with that flatter period, should homeowners be hesitant to sell at the moment, or like why not?
Okay, so if you're in regional New Zealand, what you're seeing at the moment is pretty much what it's going to be for a while. So that's both an advantage and a disadvantage. If you're buying, it's an advantage because it means there's more stability around prices at the moment. If you're at a disadvantage, it means that if you were looking at mega prices 6 months ago, and those prices have come back a bit, then sadly they've come back a bit for a while. But it also means that you're buying and selling in the same market. So if you're selling a property at the moment and you're getting a bit less on it than you might have got 6 months ago, then you're also spending less to buy another property, theoretically, if you do your job properly. So no, I wouldn't delay. If you're in Auckland, a little bit different. And for the reasons that I just described before, I think the Auckland market will recover. When I say recover, certainly not recover back to where it was last year, because that was a once in a generational thing. But certainly recover back to some degree of capital growth at some stage soon. But I can't tell you when. I mean, it could be 2 months from now. It could be 6. It could take a while. So, I suppose the advice I would give to somebody, and not advice to use your term, Louise, but the advice that I would give somebody who was in that situation was, if you need to sell or you need to buy, then sell or buy. If you can delay, if you're in Auckland and looking at the situation and want to know where it's going to be, if you can delay selling, then by all means do so. Conversely, if you're buying in Auckland, then now's the time to do so. Because there might be a little bit more fluctuation up and down with prices, but the general trajectory is always going to be up.
Interesting. So dog's whinging at me. I've just told my husband to come and get her. So look, there's a lot of doom and gloom in the media for various reasons right now. There's a lot going on in the world. What's a better way to get your property facts and your property market facts than the constant Twitter feed or the constant news stream?
A few ways. If you're an investor, join a property investor association would probably be my best advice, because you'll get much better information there than you'll get through the media. It's not so much where you should get it, it's where you shouldn't. And my answer to where you shouldn't is, as much as I rate some of the property specific sites within some of the media, they shouldn't be your go-to source because they are focused in the main on, for want of a better word, clickbait. It's about getting people to read stuff. So the headline's going to be focused on that salacious stuff that's going to get people reading. If you look at those sites, you'll tend to find they're either focused on stuff which is about how you're going to get really wealthy by talking about how much property is going up and how well it's doing, or in uncertain times at the moment, it's going to be the opposite. It's going to be talking about, oh my God, we're about to fall off a precipice. So don't take your information about the market from websites that are telling you that it's all doom and gloom and things are over. In terms of where you should get it from, I mean, it's hard reading, but I'd be looking at things like the Real Estate Institute site. Because although they do have a vested interest, let's be clear, their vested interest obviously is on behalf of their members, the data itself can't be gamed because it's based on actual sales. It's based on what's actually going on in the market, and so the sales figures are actually going to be an accurate reflection of what's happening. And in fact, that's why when you're looking at the market overall, I'm a real advocate of using the Real Estate Institute's data. Again, not because they're necessarily spotless in this and without a vested interest, but because the data that they have is data based on actual sales, not some commentator's opinion of what the market should be doing right now. And that's the problem. A lot of the stuff that you read at the moment is based on assessments of valuation. So you'll have a commentator representing a company that does valuation assessments. They'll tell you what the market should be and they'll tell you where it is now, and you'll base your assessment of what the market's doing based on that data, which is not real. Whereas the Real Estate Institute data is based on what's actually happened to sales, and you can break that right down to regions and even in some cases down to suburb. In terms of other than that, where would I look? I suppose it just comes down to picking your commentators and knowing who you trust. And there are some good commentators out there. There are some people that I've got a lot of time for. And it's okay. Conversely, there are people, and I won't mention his name for fear of embarrassing, but there's an example who you'd want to slit your throat every time you read anything or saw anything that he had to say. He's not so prolific now. He was around 2 or 3 years ago. And it was more about being seen. It was almost a form of virtue signaling about the position that he was taking and how concerned he was about what was going on in the market and how people were being affected, rather than the accuracy of the information, that information being data led. So pick your commentators and pick the people that you trust and I guess follow them.
Yeah, I mean, in terms of who you listen to, everyone's going to be right 50% of the time, right? And I think that's been said before about some prominent economists in this space that, is it going to crash? Is it going to be a boom? You're going to be right 50% of the time. So you definitely pick your channel. And obviously, we run webinars very frequently with the likes of people like you. So Relab is also a pretty good space to get some of your information.
Yeah, and going to a bit more specific topic, you gave a great piece about why the government should prioritise first home buyers more. Can you talk us through the reasons for that?
I can. It's interesting. I occasionally get accused of having a vested interest in the market and being out to line the pockets of wealthy property investors, which I always find interesting for 2 reasons. One, because in terms of my own property investment, it's pretty much past me now. These days, it's about sort of sitting on what I currently have. But focusing more on providing advice to the market. But the other reason that I always find it amusing is because my major focus, and this has been the case for many years, my major focus is on first home buyers, not on property investors. And the reason I say that is partly obviously because I want young people to be able to get into their first home, but also because from a societal perspective, it's the best possible thing that you can do. And I'm a real advocate of governments putting a really strong, if not primary, focus on home ownership, particularly first home ownership. And the reason for that is because if you look at the ills that plague societies, crime, poverty, all of these other things that we're so concerned about, a big tranche of that stuff gets solved when people own their own home. So to the extent that a government can move the needle on home ownership, to the extent that it can get more young people into their own home, it solves, as a consequence of that action, a whole range of other things that it would have to deal with down the track as a society. Now, to put that into some perspective, we actually do okay when it comes to home ownership. And I say only okay because although our rate of home ownership is not as good as it is in some other countries, it's about 65% depending on how you measure it. It's been at that level for a really long time. In fact, we've got data that goes back right back into to over 100 years ago, to about 1916, that tells us that in 1916, about 56% of New Zealanders owned their own home. By 1926, it had increased to about 65%. And there it sat for a really long period of time, with the exception of the 1990s when it actually went up. So in 1990, home ownership got as high as about 73%, and then it came back down again, and it's stabilised in the early 2000s, and it's sat around that 64% mark again ever since. But I'm more aspirational than that. We've got 73% before. And I think we should get there again. I think it's regardless of who's in government, that should be one of the primary things we focus on. So much so, and I'm a right winger economically, but so much so that when it comes to home ownership, I'll actually advocate some sort of form of social intervention by the government in terms of assisting people. Now, that doesn't necessarily have to be money. It could be in the form of guarantees around deposits. But it does say to me that rather than having stupid rules around deposits that the Reserve Bank puts in place called LVRs that say you've got to have a 20% deposit, we should actually be going the other way, particularly with first-time buyers. We should go back to where we were 10 or 15 years ago and saying if your income's strong, then there might be circumstances where you don't have to have a deposit at all, where you should be able to borrow the whole lot. And where the government maybe stands behind 10% of that and says we'll guarantee that for the first 5 years until such a time as you've increased some equity in that property. But I'm absolutely focused on this idea that government needs to do everything that it can to get as many people as possible into their own home and to increase that percentage over the next 10 to 15 years to an even greater level than it's currently at.
Yeah, so with the triple CFA, I mean, we have seen some banks obviously taking it to the extreme where, we're looking at how many cups of coffee you've had over the last week. It is really, really difficult for first-time buyers right now. And I have a son who's in his final year at university at the moment, and he's sort of starting to think about property, and I know how hard that is. So we're seeing interest rates rise. We're seeing the official cash rate moving, and you could probably be confident that it's going to move a few more basis points as we go through the year and, maybe for the next 18 months. Why shouldn't we and first home buyers get too consumed by that data that we keep seeing on the news? Interest rates keep rising, official cash rate keeps getting bumped up. We know that OCR is going to keep going. Why should we not get too consumed about that?
Two reasons. One, because even at the level it's at the moment, and you'll know this better, this figure better than I will, Louise, but even at current levels, we're way under where we were 3 or 4 years ago. So we're acting like the world's ending at the moment based on the fact that there's been that the drop in interest rates has stalled and are now going up again. But I think, and you'll correct me if I'm wrong, Louise, but I think 3 or 4 years back, the OCR was as high as 3 or 4%. It was much higher than it is now. And so we would have to climb an awfully long way back up again, even to get back to the point that we were previously at. Now, the normal counter to that, and it's got some validity to it, is yes, but house prices have gone up, and therefore the imposition of the cost of that interest rate now is higher than it was because you've got to pay more interest than you might have paid 3 or 4 years ago because houses cost more. And that's true. There's some truth in that. But I don't see interest rates getting back to where they were even 5 years ago, let alone 10 or 15 or 20 years ago. So that's the first reason. But the second one comes back to what I said before, and it's around this concept of what I call normalization. And it's not a science. It's just something I've observed over the last 20 years. But it's this idea that when governments bring in new rules, or indeed the Reserve Bank, as they did with the LVRs, when they bring in new rules in the housing market, that we all panic for the first 5 minutes, and there's headlines, and there's concern that the world's going to end, and then it doesn't, and life carries on, and life continues and returns to some form of normality. And I say that as somebody who was around in the 80s when mortgage interest rates were over 20%, and there was a time when that was normal. To use that word, it was normal. People paid 20% interest rates because they did. That was what the market expected at the time. Now, I'm certainly not advocating that we would go back to that, but what I am saying is that there's a period of concern and panic, followed by a period where we go, well, actually, I'm still here. I haven't died. Life's going to continue, and we do normalise. And that's not just true of property, it's true of pretty much everything that we do as a society and a civilization. We panic about things. There's this concept called sawing sawdust, which is this idea that there's a point beyond which once you've sawed a piece of wood, you can't saw it any further. And that would be good advice for most of us when it comes to being concerned about the property market. Be cautious, plan, be aware by all means, but don't panic about the stuff that you can't change.
Cool. And in one of your most recent commentary pieces, you talk a lot about how there's a lot of public idea that the government's tax policies are aimed at punishing particularly property investors. Can you talk us through your views on that?
I can, yeah. Well, property investors, this is a philosophy that goes right back to 2017. This government came in on I was going to say a wave. That's not true because they only got 36% of the vote, but let's not go there. But they came in on a sentiment amongst some of their supporters of anti-property investment, and they have quite fastidiously over the last 4 years rewarded that part of their electorate with wave after wave of measure, which is designed to attack property investors under what, in my opinion, is this naive, silly belief that if you do that, somehow you're going to fix the housing market. And so there have been things like the ring fencing of tax losses for property investors, which means that you can no longer use those losses for anything other than profit that's derived from directly from the property itself or group of properties. The elimination of interest deductibility for investors, which isn't just foolish, but it actually goes against the trend of pretty much every other country in the Western world, which applies normal tax deductibility rules to the operation of a business. And then there's other things, some of which has actually been quite good. There's things like the Healthy Homes legislation, which in my view was actually not a bad measure. It was, what it has done is it's provided a benchmark to the market to say this is what we regard as a minimum requirement for a rental property, which was not unreasonable, except that the government gave themselves 2 more years to apply it to their own properties than they did to the private sector. And there have been other things. The imposition of the additional rules on the loan to value ratio restrictions, which was so instead of being 20% deposit for investors, it was 40%, and a range of other things. And I don't think those measures are over. Oh, the bright line test was another example, going from the 2 years, which National introduced for some quite specific reasons to tidy up an area of legislation, through to 5 and then 10 years, which meant that it stopped being about tidying up tax evasion and became about capital gains tax. Which effectively is what that is, regardless of what the government says. Having 10 months prior to that made an absolute assurance to the country that they would never introduce capital gains tax, then proceeded to actually do exactly that. So as I say, it's based on this belief that by doing these various different things that you will somehow fix the property market. Now, the problem with that, and it comes back to what I said before about home ownership, is that about 65% of New Zealanders own their own home. The math on that is about 35% don't. Why is that important? Well, if we lived in a country where the population never increased, it wouldn't. That would be fine. We would have a set number of rentals needed, and we wouldn't have to worry about it. The problem is that our population's increasing. It's 5 million now, and the trajectory it's at the moment, it could be as many as 6 million people within 10 or 15 years' time. And if you take those percentages, that means that instead of 35% of 5 million people needing a rental property, 35% of 6 million people will need a rental property, which means that that's a continually growing figure in terms of the actual number. Now, there's only 2 parties that can provide rental property, either the private sector, which currently provides by far and away the bulk of them, about 450 to 500,000 of them are provided by private investors, or the government, which currently, and there are some small players, there's city councils and there's also some non-government organisations, but basically all of those parties combined provide the remainder of the rental property within our market, which is about another 80,000 units. So what that means is that if I'm right, and we need to use that million figure, another 350,000 rental units, then those units either have to come from the private sector or from the government. Now, if you've got a government that's beating up on property investors and trying to make it difficult for them to get into the market, then it's a false economy, because the effect of that is then all of that responsibility will land back on them, on the government, and that simply can't happen. It would bankrupt the country. So that will have to be corrected by an incoming government, and it will have to be corrected quickly, or you won't have seen anything like the housing crisis that we will encounter over the next 10 or 15 years. Sorry, the rental crisis that we encounter over the next 10 or 15 years.
Yes, you sort of lead me quite nicely into my next question. But just a comment there that I had been reading some international research just around, treating, landlords and property investors, treating tenants as customers, and, really raising that bar in terms of service. And, me being in the SaaS industry for a number of years now, that makes perfect sense to me. And also being a landlord, we want to provide the best possible service to our customers as possible. So which leads me into, we're staring down the barrel of the new Bright Line tests and interest deductibility getting phased out over the next few years. I think it's only just come in last week. I think it was, we're hitting 25% now. How do you think the government's policy making, or fast and loose, some might say, policies and decision-making processes affect the property market? And do you think that they have a responsibility to get involved in something like the free market?
The government. So firstly, just before I answer that question, let me just reinforce something you just said about the customer approach. Nothing that I just said before should be read to mean that the tenants are the enemy. Quite the opposite, in my view. And these figures are, out of my head rather than empirical, but they're a guide. 95% of landlords are good, decent people, just providing property as a way of providing for their retirement, and equally 95% of tenants are decent people just wanting to put a roof over their head and provide, in a lot of cases, for themselves and their kids, and provide somewhere to live during that portion of their lives. So this idea of turning it into sort of a class warfare between landlords and tenants is a falsity to me, and it's used by governments to effect, but it's not real. And we need to see tenants as on our side of the equation, and we need to be doing, as you say, everything we can to turn that into a customer-driven service and to provide, warm, healthy homes that are making sure that people are actually looked after and that they've got a quality of life. So I agree with everything you just said there. In terms of the government, I'm not sure about private sector. The only thing I can say in that regard is if I think back to the 90s, and I'm not sure whether people actually understand what happened to when National was in government in the early 90s, but they had a view, which I absolutely agree with, which they've since abandoned, which was that if the government was going to be involved in the provision of housing, it should be involved in supporting the private sector to do that rather than providing the homes itself. So its argument was it could either have 60,000 physical units where it was basically a lottery on who actually got those houses, and beyond that, it was tough luck. So if you were lucky enough to get a state house and it was subsidised, great. If you weren't, then it was tough luck. Or you could get out of the business of owning houses, which is why they did that at the time. And instead of that, you could provide the funds that you previously had provided to state housing to actually supporting the entire rental industry by producing what they ended up calling an accommodation supplement. And so the idea behind that was, instead of housing 60,000 people, you could potentially house 100,000 or 150,000 by providing income support to those people. Now, I think that was a brilliant policy. That was a far smarter policy than the policy of owning physical units. But when Labor came back in 1998, they disagreed with that. And not only did they keep the accommodation supplement, so they kept that in place, they then reintroduced the concept of owning state houses and started building that stock back up again, which I think is foolish. And I'll think that's foolish till the day I die. It just makes no sense to me. So in terms of government being involved in the provision of housing, it has got a role, and it has got, if you like, a private sector role. But that role to me is in the income support of those who are most at need. Now, the other problem you've got is at the moment with the government involvement is, and this is where I think National made a mistake. National introduced time-limited rentals, I think in 2008, 2009. And the idea behind those was that every few years that the government, if you were a state house tenant, the government could go back, and if you weren't still in need of that accommodation, that they could kick you out and they could put somebody else into that unit. I understand the rationale behind that. The problem with it is that's now been extended in the public consciousness, and you've now got people saying, well, if people aren't behaving, they should be kicked out by the government. There is a problem with that, and the problem is that the government is the landlord of last resort, which means that if you've got a tenant who no private sector landlord is ever going to take into one of their properties, there is only one other party who can do that, and that's the government. So you've got this conflict between, on the one hand, saying if people aren't prepared to look after the property that's provided by the state, they're not entitled to it. You should give it to somebody who's going to look after it. But then on the other hand, if they're not going to be in state-owned property, where are you going to put them? Because there's nowhere else for them to go. So there are some policy conflicts there which need to be resolved.
Awesome. That is the end of our questions. I'll go on to a couple of the audience's questions before we wrap up. There was a question from Nathan. At the moment, Auckland has the largest decrease in house price index. How do you see this playing out in other cities like Tauranga?
Yeah, well, the first comment I'd make is don't base your decisions on the events of the moment. By which I mean there are some things happening at the moment that are about sort of the reshuffling of the chairs, the chairs on the Titanic, if you like, and we're seeing some changes taking place, and that's playing out in terms of headlines around valuations and things. If you've got the luxury of waiting, just wait. Give it a month or two, give it a little bit longer if you can, and let's just see how this all settles down. My anticipation is that in respect of the regional markets, that they'll settle around a relatively flat level over the next 2 or 3 years, and there they'll stay. And so, in respect of your Tauranga point, your Tauranga question, that I would expect Tauranga prices to sort of flatten and level off. In respect of Auckland, and this is a bit where I'm putting my neck on the line a little bit, but let's just see what happens. I think Auckland will recover. And by recover, I mean I think Auckland will start to get a little bit of healthy growth again at some stage over the next sort of 6 months or so, and you would expect to see that continuing for the next 2 or 3 years, if indeed it follows the trends of the last 40 years.
Cool. And one from Kushla. I'm selling in Martinborough. I heard your opinion on the regional market. What percentage should I drop my price to get this account?
Yeah, I'm definitely not going to answer that. I wouldn't have a clue. Firstly, I don't know the Martinborough market well enough to be able to give an informed answer. And even if I did, I'm certainly not going to put myself in a position where Kushla and her family are making their decisions based on anything I might say on a video. So look, the only thing I can say there is go and talk to a local real estate agent, maybe a mortgage broker, and just get some idea of what they think your best approach is.
You're a wise man, Ashley.
And another one from Nathan. What do you believe the biggest influence that triggers a housing boom? Affordability, interest rates, population growth, etc.
Interest rates by a country mile. So it's interesting. If you'd asked me that question 6 or 7 years ago, I would have given you a variety of different triggers. I would have said foreign investors. I might have said property investors back then. I certainly would have said immigration. I would have said a range of different things. As I've got older and hopefully wiser, and I've looked at what happens to the market, I've dismissed almost all of that. And I've now settled down to recognizing that one thing is probably 90% of the cause of an interest rate increase, of housing price increases, and that's interest rates. And the reason I say that is there's a really strong causal link between what's happened to interest rates since the mid-1980s and what's happened to house prices since the 80s. And interest rates have come down and house prices have gone up. Now, interestingly, you could say, well, that's a contradiction to what I said earlier, and that if that's the reason that house prices have come down, then surely, if interest rates are now going up, then the reverse should apply, and that house prices should start coming down again. And the answer to that is that would be true if this trend was going to be for a long time. So if interest rates were going to go up for a long time, and we knew that, and there was going to be no respite from that, they were going to keep going up, then I absolutely agree. House prices would start to descend quite dramatically as a result of that, but they're not, and we know that they're not. We know that they'll go up for a little period of time until that inflation's been squeezed out of the economy, and then they'll start to come down again. And I would also put on that just a caveat to say that when you look at what happens to house prices over a period of time, although the trajectory of house prices is always up, so house prices always rise over time, the day-to-day activity and the month-to-month and the year-to-year activity is more like the teeth of on a serrated saw. If you think about a saw having teeth that go up and down, that's what the market does. It's going up, but it's going up and down within that all the time. So that's why I said to one of the questions before, don't look at what's happening in the moment, look at the longer-term trend, because that will show you what the market's doing.
Yeah, great advice. From Jason, I think we'll make this the last question before we wrap up. The government's interventions and policy changes haven't had the impact they wanted. What is the risk of further and more intense policy setting changes? What could these look like? And further to that, what would it be able to roll out these in the current government's remaining term?
I think there's very little fear at the moment right now, for the simple reason that the market's are flattened on its own. And so I think that the impetus that the government had even a year ago to look at measures to try and cool the market have disappeared. If the Auckland market recovers, and if I'm right, the regional markets stay flat, then there'll be no reason for them to do anything there. If the Auckland market recovers, as I think it will, and gets sort of 4 or 5% growth per annum over the next few years, you may see some reactivation of government interest in doing that. But by the time that happens, we'll be running toward the end of this current government's term. And for what it's worth, I know this isn't a political forum, but I would eat my hat if they get a third term. So I think we'll see some quite dramatic change under a different government from 2024, late 2024 onward. So I think that the risk of that has come back quite dramatically as a result of the changes that have taken place just in the last 3 or 4 months relative to what I talked about at the beginning of this presentation.
Awesome. Cool. We'll wrap up there. Thank you everyone for coming along, and a huge thank you for Ashley joining us today. I'm sure everyone learnt a lot. And keep an eye on our next webinar. Cool.
Thanks, James.
Thanks, guys.
See you, everyone.
Bye.
Fellas.